What is up, YouTube? This is the Working Investor. In this video, I'm going to talk about a theme that I coined. It's called parallel diversification, or single fund diversification of fund managers, or easily said, parallel diversification. For example, when it comes to the space of the high yield dividend, option space, there are so many funds coming out right and left. It almost seems like there's a fund war, but it makes it kind of more difficult for the consumer. But also, it also provides a lot of ways to diversify. So even if you have fund A, B, C, and D that are on the same underlying and the same type of option strategy, this is all my opinion, not financial advice. See all my disclosures. I'm not a financial advisor. It is my humble opinion as a random guy on YouTube, retail investor. I feel like there is a benefit for branching out the risks. So let's say if you have, 15 grand you want to put into the S&P 500 and you're looking for a 0 day to expiration cover call strategy, right? So think about this for a second. We have the sector of the S&P 500. Then we have a strategy called 0 day to expiration strategy of selling options. And we know 0 day to expiration offers the most amount of premium because there's massive theta decay. And you want to have it on S&P 500, and you want it to be a covered call or a synthetic covered call. Even in this very narrow type of strategy, you have three options right now. You have the option of XDTE, and this is by Roundhill. And you could see that even with these three different flavors, you have little nuances. Like XDTE, they do overnight exposure. That's their type of style. So you have a little bit of an overnight exposure in the S&P 500, as you could see over here, and that's unique. And there's something called gap up and gap down in the market. A lot of times, if you notice when the market opens up in the morning, you notice that from the time it closed the night before, and then now it opens up, the market just shot down. It's called a gap down in the market. And a lot of times you'd see the market closes at a certain price, your stock or ETF closes at a certain price. The day starts trading 9:30 Eastern time. And all of a sudden you see it just jumped up $1 or $2. You see that also specific a lot of times with earnings seasons. But even throughout the year, non-earning seasons, you see gap ups and gap downs. So there's a lot of studies about this, and statistically, some studies have shown that there's more gap ups than gap down. So you get that overnight exposure. That is something unique with Roundhill, right? So just by having this little narrow type of investment strategy, you have a flavor of, that overnight exposure. Now let's look at another choice we have. So we mentioned XDTE is Roundhill. Then we have TSPY. TSPY is a newer player to the game. Let's look into the fund. They have a little bit more upside potential. That's how they play their options. They go a little further out in delta. They give the stock, the S&P 500, a little more chance to go up. And they actually own the underlying. So it's not synthetic. It's actually covered calls. They actually own the underlying. So you can see here TSPY. That's by Tap Alpha. So this guy who runs this fund, also the expense ratio is a little less, but that's just a small thing. But he actually is a software engineer by trade, and he actually has a proprietary algorithm that does it. But I've watched several of his videos of the fund manager, and he does, and you see here, they actually own the underlying, right? And basically he'll actually do some override. If he expects there could be the market could really pop that day, he may put his strikes a little further up to give you more chance of deriving more upside. So basically, you could see that Sai Katara is the guy I'm talking about. So it's a whole different style, a different flavor of the same subset, little corner of the world of 0 day to expiration cover call / synthetic cover call S&P 500. Now let's look at a third option. Look at this. We got three options of this very, very nuanced type of way of trading. So YieldMax came as a new player to the game. They have a ticker symbol SDTY. I guess S, I guess, for S&P 500. DT is for day to expiration, meaning 0 day to expiration. And I guess Y for yield max or whatnot. So I watched a video from Max Convexity. He was interviewing with Jay. I was trying to find the video. I believe it's this one over here. That's 58 minutes. I'll post it into my description, this video over here, so you could watch it. But I believe he talked about in this video with his interview with Jay, who's the fund manager. I think it's Tidal now. That's the name of the company, if I'm not mistaken. And he spoke about something unique with SDTY. He mentioned in an interview that, see, they actually would and they could manage the trade intraday. He said that it could do intraday moves. As far as what I understand, TSPY and XDTE, they kind of put on the trade and that's it. Set it and forget it and let it kind of close out at the end of the day. But with yield max, if let's say you do a synthetic cover call, which they do, I believe it's synthetic cover call 0 day to expiration, and the market goes down, so they can close out the call for a profit, and they can put on another call throughout the day. So so that's something unique that they're more, they'll be a little bit more active. They're more active than the others, which could be a good or bad thing, because sometimes if the market has two-sided action, you may be regretting that you changed your strikes, because then you could be a winner on the initial strike, bring the strike down closer to the money, and all of a sudden the market ends popping back up, and now you've breached that newer lower strike level. So who knows if it's a good or not? Hindsight is always 2020. And this is just referring to their website, the SDTY, which just launched recently. So we'll see, I don't know if that's a true distribution rate. We'll find out later on, if what the real distribution rate is, because I think they only had like 1 week worth of payments. And another thing to note is that when it comes to weekly payments or monthly payments, so XDTE pays weekly and SDTY pays weekly. So both of these funds would provide there's 52 weeks in the year. So logic would say you get 52 payments of the year. So let me put that in. So I just plugged it into the paper. So, and then TSPY pays monthly. It's monthly pay. So it's 12 months of the year, 12 payments. The reason why I specify 12, because some places pay every 4 weeks. Every 4 weeks would be 13 payments of the year. So I like to specify, are you getting 12 or 13 payments or 50, 52 payments. So you could see there are some pros and cons to each of these type of style of trading, and they all trade the same underlying, they all trade the same expiration, and they all have very similar strategies. But you could see that within this subset, you have 3 different flavors. So that's why I'm saying that, let's say, again, just not financial advice, but let's say if you wanted to deploy 15 grand into this type of strategy, if somebody were to, instead of putting 15 grand into one asset, let's say they want to have 15,000 of exposure with this type of strategy, they're comfortable with that risk, they've read all the prospecti, and make sure you're comfortable with the risks, speak to a financial advisor. But let's say, would it be better to just put 5,000 in each of them and kind of split it up? So you're kind of, if one strength, so you may have little different strike prices, different type of flavors in it. So I call that parallel diversification, or single fund diversification of fund managers. You're spreading it out through different fund managers who have different styles, and you can have 2 brilliant minds that are amazing option traders, but you can have differences of opinion. You can have a lot of the options trading is user dependent. A lot of times it's all about the execution of these options. And sometimes, somebody could be right one day and somebody could be right another day. So that's what I like to do. That's just my personal journey, not financial advice. I hope you guys enjoyed. This is The Working Investor, over and out.